Fractional reserve banking. Fractional reserve banking in this instance is where a bank takes, let's say, 10 ounces of gold and gives the depositor a demand deposit for 10 ounces of gold. The banker then keeps 1 ounce of gold and then loans out the other 9. The banker can do this because he has found that he really only needs about 10% reserves to satisfy withdrawals, and 90% of all transactions are people just handing banknotes to each other. The bank then uses the return on these investments to cover the storage costs, give the depositor an interest payment, and make some money for itself. Fractional reserve banking is unnecessary. If one wishes to see their wealth grow, they should invest in a mutual fund. If one wishes to store their wealth, then they should buy many different types of precious metals. If one needs a medium of exchange, they should trade coins made of precious metals. Fractional reserve banking almost always fails eventually because the demand deposits don't represent real gold. Let's just use gold. 90% of the gold they are supposed to represent is already loaned out. And so the demand deposits are 90% fraudulent. And eventually people begin to recognize this fact, and some begin to withdraw their savings, then more and more until a bank run develops and the jig is up. The bank then has to call in the loans, liquidating the investments for what gold and silver they can salvage to give back to their depositors. They got to bust some bricks. And this increase in the checkbook money also leads to inflation, because now not only do you have 90% of the deposited gold being loaned out, but also 100% of the value of deposited gold in the form of demand deposits. So you have fooled the market into thinking there's more gold than there really is, because the checkbook gold is treated the same as actual gold. This is a false signal which leads to overinvestment and a boom and a bust, though not on anything approaching the damage that is done by state central banks such as the Federal Reserve. At this time, deposit insurance companies popped up, private FDICs, when there was free banking. The difference is that these deposit insurance companies were paid for by the banks and depositors, not by the population at large. Today, the FDIC is a bailout guarantee, which means the state will bail out bad investments in a lousy bank, and the state gets its revenue from the taxpayers. Which means that you are bailing out bad banks. Which is to say that you will have to pay for the freely chosen blunders of others. And if you don't, you'll be thrown into a prison, and if you resist, that you will be shot. So welcome to the Dark Ages. This is where angry white man talking about the gold standard comes from. It comes from this FDIC insanity. One will hear stories about this time period referring to wildcat banking. And because fractional reserve banks are inherently fraudulent, there were many bank runs. And this is good. Bad investments were being cleared out in the free market. Right? And the bank run was a clearing out of those bad investments. Unfortunately, the population was apparently not smart enough to realize that fractional reserve banking was inherently insolvent, and so continued to invest in fractional reserve banks. And they would fail, and then they would invest in another one. Idiocy. The free market solution would be to tell people to stop investing in fractional reserve banking. Stop sticking your hand in the fire. And free banking ended during the Civil War, and oh so predictably never came back. War is the health of the state. Remember that money is just a medium of exchange designed to prevent people from having to find a double coincidence of wants. Without an agreed upon medium of exchange, people would have to trade what they had for what they wanted with people who had what they wanted and wanted what they had. For example, if you are a tomato grower and you want pickles, then the only way you could get pickles without money is to find a pickle-growing tomato wanter. Right? And conversely, if you grew pickles but you wanted tomatoes, you would have to find someone who grew tomatoes and wanted pickles. Right? But what happens is that it is found that a lot of people like gold and silver and can use it for things. So you decide that because so many others will trade goods for gold and silver, you will accept gold and silver in exchange for the tomatoes that you grow. Not because you want gold and silver for their own sake, but because you know that others will exchange goods for these gold and silver tokens. And so that is what money is. It's not complicated or something that needs to be centrally planned. It's just another intersubjective consensus. And when the state is viewed as legitimate by the intersubjective consensus, then the state can require people to use pieces of paper they just printed, which leads to all the problems stated earlier.